This is the Money Hour with your host, Tina Mitchell, on Alternative Talk, AM 1150. Now, back to the show with local mortgage and finance expert, Tina Mitchell.
Welcome back to the Money Hour with your host and mortgage expert, Tina Mitchell, right here on 1150 AM KKNW, the Saturday, September 13th show. I'm committed to providing you knowledge needed to be successful in every area regarding your financing. Knowledge is power, and that's why that's exactly what you'll receive listening to the show here today. If you're hearing my show at a different time or day, you're listening to a rebroadcast. To talk with myself or any of the guests that I have in the studio, please feel free to call the show at 1-855-400-1150. Again, that's 1-855-400-1150 or online at themoneyhour.com. And in studio right now, first time that I've had in studio, Brad VanVechten, founder and managing member for Private Wealth Management Solutions. A financial advisor is a professional who renders financial services to clients, but how do you choose and find the best one to represent you? Brad, thank you so much for coming into studio today. Excited to have a chat with you.
Absolute pleasure. Thank you.
And a little bit about Brad. He is an independent, fee-only certified financial planner and is experienced client-centered financial advisor and investment manager with over 20 years track record of driving account growth and providing sophisticated financial advice to individual families and business owners. Brad's professional designations are certified financial planner, chartered financial consultant, certified investment management analyst, and chartered life underwriter, and is a Washington State registered investment advisor. Brad, thanks again for coming into studio. I always like talking in your arena because I think it's really important, obviously, on how we invest our money, the safest ways and the smartest ways to invest it, and also who we choose to represent us in this important financial piece of the of our blueprint. So, what is the difference between a registered representative and a registered investment advisor, Brad? Can you share that with my listeners?
Happily. So, it's interesting. Most people don't understand the distinction between the two. A registered representative works for a broker-dealer.
Okay.
An example of a broker-dealer would be somebody like a Merrill Lynch, even a Charles Schwab, ING, Prudential, any of these large companies would be broker-dealers. And broker-dealers supply, if you will, the menu of investment solutions and products that their representatives can use.
Okay. And so between the broker dealers and registered investment advisors, what's the difference in how each are paid?
Okay. And the first thing I train my clients to do is always ask, and it doesn't matter what sort of professional you're working with, always ask how they get paid, because I think that's important.
Of course.
But to back up to your previous question, a registered investment advisor doesn't work for a broker-dealer. They work for the client.
Okay.
And they have a fiduciary obligation to work for the client. So generally speaking, registered representatives that work for broker-dealers are paid by commission.
Okay.
Whereas registered investment advisors can be paid a number of ways. They can be paid hourly by the project if there's a limited scope of work, or if they're managing a client's assets, they can be paid a percentage of assets under management.
Okay. So, Brad, what makes an independent financial advisor unique from an advisor working at an institution like a warehouse or insurance company or a discount broker?
Very good. So, a registered representative working, for instance, at an insurance company, as an example.
Okay.
I always like to use this analogy. So, if the only tool you have is a hammer, all problems tend to look like a nail, and so there are going to be biases based on who your employer is. If you work for an insurance company, generally speaking, you're going to try and solve most people's issues with the use of insurance products,
of course.
Annuities, life insurance, and
which
so
are good
forth.
products, but you want to make sure that you've got...
What you want is a general... somebody who looks at the big picture.
Yes.
As opposed to somebody who has a preconceived bias to sell you a given product or solution. And those are typically driven, frankly, by the level of commission offered.
Okay.
By those products. So You just want to be careful and selective, and that's not to say that people work for broker dealers are bad people or anything like that. Generally, the vast majority of them have their client's best interest at heart, but perhaps they're somewhat biased, just given the way they're compensated.
And I know exactly what you're talking about because not anymore in the mortgage industry because of the Dodd-Frank Act and a lot of things that are happening with CFPB. But as a mortgage consultant. Now there are not commissions that are paid differently for a VA product or an FHA product or a conventional product. It's all the same comp plan. But back before the crisis happened, and that's exactly what it was. And just like you're saying, I mean, you've got majority of you people that are taking care, mortgage consultants that were taking care of their clients were not selling based on product, but they were selling based on what was best for their client. But you and I both know, and as a listener listening today, when you're in sales, there is a percentage of those people that are not looking out for your best interest. So understanding how that works, then you know the questions that you can ask when you're in these different arenas and talking with different advisors, correct?
Absolutely correct. As a matter of fact, I work closely with an insurance broker who offers long-term care, and I was actually happy to learn that it doesn't matter which insurance broker you go to, all long-term care policies sold in the state of Washington have to be the same price. So, so your coverages, it all depends on your coverage.
Is that something new that changed?
It is.
Well, that's great.
It is.
So it's kind of the same thing as with the lending reason behind it.
Yep. So it doesn't matter if you go directly to a carrier, directly to a broker. You're going to pay the same price for the same product.
Okay. Wow. So what is the difference between a fiduciary standard and the suitability standard when giving financial advice?
So broker-dealers are subject to a suitability standard. That basically means that the clients that are the solutions offered through them have to be reasonable, and they believe that they are in the best interest of the client. Okay, that's a suitability standard. A fiduciary standard is the same standard offered by attorneys, as an example, whereby you have to offer solutions and products that are in the best interest of the client. So you have to put the client's best interest ahead of your own, number one. Therefore, disclose any conflicts of interest, disclose how you're paid, okay, if there's, any commissions or such involved, and demonstrate a loyalty to and care for the client.
So a lot of accountability
with
that.
Much higher standard.
And what are some of the biggest financial mistakes, just changing a little bit here on topic, biggest financial mistakes that you're seeing that people are making right now?
So titling of assets.
Okay, so explain that.
For instance, real estate. You can title it community property, joint tenancy.
Which we're going to talk about that with my next guest today.
Right. That's one mistake I see. Number two is appointment of beneficiaries for 401ks, IRAs, 529 plans, things like that. Some people just neglect to appoint a beneficiary in the first place, or they're out of date. So in the event of a death or divorce or something like that, you may not want an individual.
So when we're talking about out of date, I mean, how often should people really talk with their financial advisor and make sure that they've got everything? I mean, how often should you be reviewing things?
Okay, so I take the responsibility of calling my client every year.
Okay, so same as my industry. Okay,
yeah, exactly. Just to review that everyth's still in place. And by the way, if a major event happens, I want to know about it. Clearly as somebody's financial advisor. So
same thing with the mortgage. Any major event, and I would say same thing when you've talking with your financial advisor, any major change in your event, and your estate planner as well, is you've got to keep key people that you want to pick up the phone and talk with and find out how it's changing your financial picture. So, Brad, what about the most frustrating part of what you do? Because I imagine when you're responsible and working with somebody's money, that just adds a different level of stress. But sometimes there's things that just get really frustrating. What is that?
So, clients that come to me who were chasing returns, as an example, going online and working with a discount broker or whatever. And so not understanding the big picture, they're just looking at what I call the hot dot in that particular, for a given asset class, as an example. And then the second thing is market timing. People that think they can jump in and out of the market, they somehow have, clairvoyance and are able to predict the future. And just as an example of that, so a study was recently done that over the last 20 years, the S&P 500, so that's 500 of our country's largest companies, the average annual return has been 9.2%. That's 20 years, so that's roughly 7,000 days. If you missed the 10 best trading days, your return dropped to to 5.5%. If you missed the 20 best trading days, your return dropped to an average annual return of 3%.
Wow.
It just gives you an idea that you need to stay fully invested through the ups and downs and understand that you just can't jump in and out of the market and think you're going to do well.
Yeah, and I always say in real estate, being, doing mortgages and financing for homes, that real estate is a long-term investment, and the real estate market will always go up and it'll always go down, and trying to time the market is almost impossible. And I tell my clients that it is just like trying to time the stock market. Yeah. So, you've got to be in and out and go in those ups and downs. Otherwise, you can be at risk of losing a lot of that appreciation over the long term. Now, let's talk a little bit about, I'm seeing recently a lot of advertising on TV. There's a lot of golf tournament sponsorships, and I see a lot of that in my business with financial planners that I see that are marketing that in your arena. Who is actually paying for all of this?
Well, I think it's pretty clear. It's the client. The money's coming out of your pocket to sponsor golf tournaments, tennis tournaments, and all those minute ads on your Super Bowl.
Sure.
People have got to come to the realization that that's money coming out of your pocket.
Makes total sense. So would you advise, or can you give a description of mutual funds, exchange trade funds, and separately management accounts and how that works?
Okay. Well, we have limited time, so I'll just briefly, as a little background, there are actively managed mutual funds, separately managed accounts, and ETFs now. And then there are passively managed ones. So passive means that it's just a basket of stocks, as an example, that are not traded actively. So an S&P 500 index is 500. It's basically 40 stocks because they are so heavily weighted. We'll get into that, some other time.
Another show.
Yeah, exactly. But as an aside, if you think you're well diversified because you own a S&P 500 index, you're wrong. And we can talk about that further some other day. Mutual funds, likewise, is a basket of stocks. It can be actively or passively managed. And then ETFs are a relatively new advent. They've come out in the last 10 years or so. And that, likewise, is a basket of stocks, generally passively managed. In other words, they don't change, and you're going to live with that basket of stocks for a period of time. So as a quick aside, if you think you're getting a diversified portfolio by investing in the S&P 500, just a quick note that the top 4 holdings in the S&P 500, which are ExxonMobil, Apple, Microsoft, and Procter & Gamble, it actually represents 11% of the total value of that index. And if ExxonMobil runs a ship aground, you own Exxon, and there's nothing you can do about it.
Yeah, wow.
Okay.
And I think it's so important, and I know you do as well, Brad, in diversification and really building that entire asset class. What are you telling your clients right now when it comes to real estate? Let's wrap up with this before I got to take us to break.
Absolutely. So I think everybody, if they have the wherewithal, should own real estate, specifically as their principal residence.
What about real estate with mortgage?
Absolutely. It's one of the benefits that our government gives us is that the mortgage interest deduction is tax deductible. And, frankly, when I see people out there espousing the benefits of paying off your mortgage early, I just don't see the benefit of that. Given real estate over time tends to just stay up with the rate of inflation, whereas I indicated earlier, the stock market, again, over time, the average of 9-10% a year.
Yeah, so you just look at your interest rate and realize, the thing with real estate, I think people don't think about it, is it's a totally different asset class than anything else, and how it's going to appreciate. It doesn't matter how much you owe against it. It's based on the value of your property and also on your other assets. When you're actually liquidating and pulling from that asset class to go into real estate, now you're actually bringing down that total investment gain that you're going to have on that asset. So look at the true cost of the rate after your deduction for home ownership and, determine whether or not you feel over the long time you're going to be able to earn and compound at a higher return.
Well, as a matter of fact, right, and benefits of leverage.
Exactly.
Huge benefit for real estate that you can't get anywhere else.
Yep, totally agree. Brad, it was so nice having you across the desk here for the first time, and look forward to bringing you back. Thank you so much.
My pleasure.
Coming up next in the Money Hour, we're going to talk to an attorney. It's been a little while since I've had an attorney in studio to talk on this topic. We're going to talk about Washington State and if you're going through a divorce and how that's going to affect your property. I have Vincent Humphrey, attorney with Barrera Legal Group, and attorney John Barrera, owner of Barrera Legal Group, right here on 1150 AM KKNW after this short break.